Good afternoon. On this week's update, we'll cover S&P 500 earnings, rising valuations, and the capital intensity of the market and today's leading technology firms. On the earnings front, S&P 500 companies just had their best quarterly results from an earnings beat standpoint in the last 4 years, with over 80% of firms exceeding expectations for the quarter. Unsurprisingly, full-year earnings expectations are again rising for 2025 as well as for future years after declining significantly in the spring due to concerns about tariffs. S&P 500 earnings are now expected to rise 8.4% this year over 2024 results and another 11.5% in 2026. Typically, as earnings go, so go the markets. With markets close to their all-time highs again, valuations are becoming extended relative to their longer-term averages. This chart shows that the forward price-to-earnings multiple on the S&P 500 is back above 24x compared to its average of 18x since 1990, and that the free cash flow yield has dropped to 2.7% compared to its long-term average of 4.3%. As a reminder, high valuations tend to be poor short-term indicators of future market performance, but they do correlate with lower returns over longer time horizons. The key question is whether is this time different. As we have discussed in prior correspondence, comparing today's market to that of the past is challenging given the changing nature of the U.S. economy. The valuation paradigm that existed in prior periods in U.S. history was reflective of a more capital-intensive industrial and manufacturing-heavy economy, whereas asset-intensive businesses comprised 66% of the S&P 500's market cap in 1980. Today, that number is only 17%. Asset-light businesses, such as technology firms, now account for about half the market's value. These firms tend to be less cyclical and thus trade at higher valuations. Now, back to the question as to whether this time is different. Up until a few years ago, the answer probably would have been yes. Tech firms of the 2010s to 2022, the year of ChatGPT's release, were different in nature from a capital and asset intensity standpoint compared to industrials of the past. Software scales much more rapidly than physical factories, as the marginal cost of new revenue approaches zero. Obviously, that's not the case in the realm of physical goods. Today, artificial intelligence might be again changing the capital intensity dynamic. As tech firms commit to spending astronomical sums to satisfy rapidly growing demand for data centers and AI computing resources, they're beginning to resemble industrial-type firms of previous eras, but on a much larger scale. With AI power demand expected to increase 31-fold over the next decade, the large tech firms involved in building out AI infrastructure keep raising their capital expenditure guidance. At the beginning of the year, the main U.S. data center firms were projecting $329 billion in capital expenses for 2026. Post-second quarter earning results, that number has now risen 46% to $478 billion, and we expect it to continue rising for some time given the competitive dynamics in the AI space and inability to meet current demand. These investments in compute resources likely make sense from a long-term perspective, but it's changing the nature of these companies and, given their outsized weight in the S&P 500, the nature of the market in general. The ratio of capital expenditures to sales for U.S. publicly traded firms building out AI-driven data center capacity have more than doubled since 2021, the year prior to the release of ChatGPT. While we like investing in these firms, the risk to them, and to be clear, it's not so much an operational risk, is that investors reassess the multiples they're willing to pay for firms whose capital intensity has materially risen. From a valuation perspective, the key question we're grappling with is whether we're heading back to the future, meaning are today's tech firms looking at a future that, from a capital deployment standpoint, more resembles the economy of prior generations? If the answer is yes, it follows to ask whether their valuation multiples will eventually reflect this shift as well. If you have any questions about today's update or your portfolios in general, please don't hesitate to reach out. Thank you and have a great start to your week.